So Celsius reminded investors that their inventory is recorded on a FIFO or first in, first out basis, and as a result, they did not see a material impact from tariffs in the second quarter. But they do expect tariffs to impact the overall margin profile through increased costs across their raw materials in Q3 and Q4. And the reason why when you're using FIFO, it doesn't hit your margins immediately is because of what FIFO stands for, first in, first out. When a business is using FIFO accounting basis, that means if they ordered inventory throughout the year, and let's say the inventory that they purchased in the beginning of the year, they paid $1 per unit, and the inventory they purchased towards the end of the year, they paid $2 per unit. They account for that when they make a sale. They account for it by using the inventory that they had on hand first, so the lower priced units. And so that creates a buffer between when your cost of goods sold increases and when you account for those cost of goods sold in your financial statements. There's a lag between the increase in cost and when they're reflected in your financial statements. That's what the management team is telling investors here, that they are experiencing a higher expense as a result of tariffs, but because of their accounting method, it's not yet reflected in their financial statements, but they do expect it to be reflected in their financial statements in the third and fourth quarters. And this is going to be the case for many, many companies here in the United States as a result of the increase in trade barriers. Now, some companies use a LIFO method, which is last in, first out. So that means the company's most recent inventory is the one that gets costed when they make a sale. So they use the inventory they received most recently, and in times of inflationary pressure, that increases your cost, which then decreases your profits. So zooming out a little bit and looking at these companies' longer-term prospects, I expect Celsius free cash flow will grow from $198 million estimated in 2025 all the way up to $540 million by 2029. The company's expanding internationally, and the energy segment is growing overall in the beverage industry, so Celsius has excellent prospects. The higher cost of goods sold will be an impact for the company's near-term margins, but longer-term, the company's competitive advantages remain and are actually getting stronger with its partnerships, with its vertical integrations, and the recent acquisitions and the synergies it expects going forward. Click the link below to watch the full video.